It's that time of the month again when there is a coordinated release of purchasing managers' indexes throughout the world. We've had the one from China, the official one from China anyway, one from the UK as well, and of course one from South Africa. And unfortunately, we are still in a contraction phase. In other words, the purchasing managers' index, which measures the manufacturing activity of the South African economy, is below the cut-off line of 50. In the studio with me is the head of research at Kagiso Asset Management, and that is Abdul Davids. Abdul, thanks very much for coming in. It's I actually thought it was going to be a little bit worse given what's been going on elsewhere. So although it's still below 50, quite a nice surprise.
Yes, I think if you look at the consensus was looking for about 47.6, which is virtually flat on last month. I think anecdotally everybody knows about the issues that we've had, predominantly in the mining sector, but also flowing into the manufacturing sector. So the rise is probably a pleasant surprise for the market as well.
Why did it do? Oh, before you get on actually, because I want to pick up this point, a sort of academic point. I was noticing that Jim O'Neill, Goldman Sachs, was extolling the virtues of purchasing managers' indexes, PMIs, saying that it's becoming one of the most important data releases of the month and starting to assume more importance as manufacturing economies like China exert more of an influence. Is that the case, do you think?
I think historically it was the case in South Africa, if you apply it to South Africa. However, our manufacturing base has shrunk significantly over the years. Bearing in mind that South Africa historically has been a predominantly commodity or mining-focused economy, and then manufacturing was a close second. But over the years, because of our lack of competitiveness, unfortunately, that manufacturing base has shrunk significantly.
But so thinking laterally, of course, so we are so linked to the Chinese economy because of the commodities that they buy from us. Looking at a PMI in China almost becomes a monthly event for us.
Yes, so the causal relationship between global PMIs and especially Eurozone PMIs to South Africa is more of an indicator of our potential strength in terms of potential exports, because that is obviously our big trading partners. So any sort of recovery that we see in global PMIs, especially Eurozone, is positive for future sort of outlook for PMIs domestically as well.
Why did we outperform? What particular aspect of the PMI in South Africa actually surprised us to the upside?
I think overall most of the sub-indices did particularly well. So across the board, unfortunately, a lot of them, if you look at business activity, etc., they're all still below the 50 level. Ironically, the only one that went above 50 is the employment index, which is now sitting at about 52. But we've seen in May and August this year that the number goes above 50 and then sort of contracts the following month. So we wouldn't want to read too much into the 1 month sort of reading. And typically the way that one is calculated is the number of respondents that just need to say that there's been no change has a positive impact on the overall sort of score for that index as well.
So you're tempering the enthusiasm of people by saying at 52 it means that jobs are being created, but actually delving down into the numbers, not necessarily the case.
Yes, and also bearing in mind that we've come out of probably the ugliest strike season we've seen in many a year this year. So we've had the sort of very slow ramp up again, and there could be elements of that coming through in terms of the employment index. But bearing in mind that if you look at overall manufacturing activity levels, that is still below the 50 level. So overall, we don't see that there's a significant job creation in the sector as yet.
What about new sales orders?
Again, new sales orders went up just over 2 index points, but again still below the 50 level. And if you look at the new sales orders as a ratio to inventories, that is still below the 1 level. So it indicates that there is still slack in the system.
Explain the significance of that.
What it effectively means is that to the extent that new sales orders exceed inventories, that is a positive indicator, because it means that there's a lack of inventories in the manufacturing sector, and as a result, purchasing managers and manufacturers have to build up inventories more, and as a result, we see the flow through coming through in terms of future new sales orders as well.
Prices paid. There's a lot of talk about the weakness of the rand affecting prices. Inflation, of course, CPI inflation still below the 6 level, but a lot of people predicting that it might go ahead. What is your index telling us?
Unfortunately, the omens are not good. If you look at where the rand is currently trading, it is significantly weaker compared to a year ago. And even if you look at the 3-month averages as well, significantly weaker. And unfortunately, commodities like oil stubbornly above the $100 a barrel level. We've seen coal and iron ore prices recovering as well. And those are significant inputs in our manufacturing sector as well. So unfortunately, because of the skewness in the PPI compared to the CPI, we would expect PPI to outperform CPI in terms of its future growth rates as well.
One thing I have noticed over the last 3 to 4 months since we've been speaking, Abdul, is quite a lot of volatility in In the PMI, we are a couple of points better than many people expected, which suggests that. But is the 50 mark going to prove too much for our manufacturing sector? In other words, is this just a bounce back and then we'll retreat again in December, do you think?
Well, traditionally, this time of the year is actually quite weak. Now, we do obviously seasonally adjust the index, but I think what will probably impact the December, January, and even February periods are the fact that the rand has weakened significantly and input prices are stubbornly high. So even though our manufacturing sector typically benefits from weaker rands in terms of their net exports, because we've got such high input inflation and stubbornly high levels of pricing, our relative competitiveness doesn't increase materially because of the weaker currency. And as a result, what you'll typically find is that we will continue to probably languish below or around about the 50 level, and we won't see a significant improvement over the next 2 months.
There is a vigorous debate going on actually about whether a weak rand actually does help the manufacturing sector of South Africa. What I've noticed over the years that the rand has been strengthening is that industry has become more efficient, has become used to the rand, and actually, simplistically, they actually become a little bit lazy when the rand goes to these horrible low levels that we've seen in years gone by.
Definitely, I would support that. What we have seen is that unfortunately, because of the volatility in the rand, it's played havoc with business plans, etc. So a lot of companies, what they've done is they've incorporated a reasonably strong rand in their business models, etc. So rand between 7 rand, 7 rand 50 is typically where they'll plan for their business, and anything weaker than that is obviously a cherry on the top. However, the other big sort of driver of activity levels, unfortunately, is sentiment towards the country as well. So even though from a global competitiveness point of view, we might look a lot cheaper in terms of a weaker rand, sentiment, I think, after the issues that we've seen this year in terms of the mining sector, for example, is still very negative. So pulling that trigger in terms of making that investment decision is still a very difficult thing given the negative sentiment towards the country.
Just a quick one. This is the last time we'll see you in 2012. What's your call for 2013? PMI base, of course.
Well, if you look at the averages, we're now averaging 48 for the sort of 2 months of the last quarter of this year. I think from here the averages can hopefully does only improve. The irony is that input prices are probably still at very record high levels. We should see a moderation in a lot of those input costs in next year, early next year as well, and that should boost the manufacturing sector as well. If the rand stays at these levels with dollar input prices coming down, I think our relative competitiveness does improve significantly, and hopefully we'll see a PMI above 50 sustained for next year as well.
Let's hope so. We could really do with it, couldn't we, on all sorts of levels.